G'day guys. So something different here. Buypoint ASX is primarily a service which is focused on a methodology which presents the best time to buy a stock. That methodology is primarily centered on the belief that the MACD, the moving average convergence divergence chart, is the single most accurate indicator of when the price of a stock is about to move upwards. That said, the first rule of technical analysis is that you should never act on the basis of a single indicator. And so while we're assessing what decisions we should make on the basis of the MACD has to be interpreted according to the context in which it happens and according to other indicators, not the least of which is common sense. The interpretation of the MACD has to be on the basis of multiple other indicators. There are exceptions to this in terms of assessing when it is an excellent time to buy a stock, and that brings us to Lifestyle Communities, share code of which is LIC. Lifestyle Communities became interesting to potential investors back in June when this happened. The story from the ABC about unhappiness amongst leaseholders who had leased their property in one of these land lease retirement villages found that, in their estimation, the terms for leaving were inequitable. The publicity that this caused, since the story was about lifestyle communities in particular, had a significant effect on the stock. Here are the fundamentals. So it's a real company. It has a market capitalization of more than $1 billion. It doesn't pay a particularly noteworthy dividend. And what's important here is that you'll see the company develops, owns and manages affordable independent living residential land lease communities. So the focus of this whole assessment is on the fact that the company owns these residential properties. So if we now move into looking at the financials, you can see that while the financials in terms of earnings haven't been great, the model of the company isn't based on earnings, it's based on investment income. And if you have a closer look at the details of the financials of the company, what you'll see, particularly down here, is that the equity of the company is $831 million, and that's very close to the current capitalization, but not the capitalization from last year shown on this chart. What you can see is that the company has lost about a third of its value in its market capitalization. This is a long-term chart. You can see that the company's been trading since 1998. After the typical volcano effect at the beginning, the company had a long history of steady growth, shooting up as a result of COVID, where a lot of people decided that was the time when they should retire from the madding crowd and find relative safety in a retirement community. The stock price retraced as COVID, or the effects of COVID, wore off, and then the company stabilized at a price somewhere above a level of support of $15. If we look more closely at the more recent chart, you can see that peak over here at about $23.50. During 2022, the company came down, re-established itself, and then continued to trade somewhere above this $15 mark, closer to $16 for most of the time. But then it took these two significant steps down earlier in the year, and this was the point at which the ABC coverage came out, and we saw what I regard as key opportunity scenario for investors, the precipitous drop, the precipitous overreaction that came with the negative publicity. If we now go to the MACD, what we see is that it was at this point that the buy point, this point here where the moving averages are about to cross, with the blue line crossing above the orange line, it was at this point on the 6th of August at the price of $8.71 that I would have recommended a buy on the basis of the MACD. And what we see since that time is that the price has continued to move sideways, has started to recover, and has stabilized somewhere about that $8.71 point. What's important here, and this is really more of a value investing proposition, is that the company's equity, the company's holdings, have gone nowhere. The company owns a large, significantly large amount of residential property, high quality, high demand residential property in Australia at the time of a prolonged national housing crisis. As we've seen, the simple equity that the company holds is around $831 million, or was at the end of the last financial year. We have to assume that it's grown because the company has continued operating as it has previously. And we now have the situation where the market capitalisation of the company is probably approximately equal to the raw equity holdings of the company in its primary assets, all those units of prime residential property. So even though the rationale of the MACD is relevant here, all the other factors, all the other surrounding circumstances, the context of the company is such that not only from the MACD position, but also on the basis of some basic maths, now is a great time to take advantage of the company's misfortune and buy in. When a company's price has dropped so precipitously, that means one of two things. Either the company is going to start to recover organically, or its status as a prime takeover target is going to attract buyers. Either way, the stock price can be expected to rise significantly in the relatively short term, and it's on that basis that I'm bringing this stock to your attention today. Lifestyle Communities, an opportunity which is not going to come along very often, and one in which the buy point has been sustained to a point where sooner or later someone's going to take advantage of it. That could be you.